Hello, and welcome to Boni's Life, where we dissect the complexities of the financial world and empower you with knowledge that transcends the headlines. Welcome back. Today, we're analyzing the cryptocurrency market's performance over the past week. This is a deep dive into the forces that shaped the digital asset landscape, a week marked by a dramatic sell-off, a surprising recovery, and the ever-present shadow of macroeconomic forces. We will unravel the narrative behind the numbers, explore the technical intricacies of the charts, the fundamental drivers of sentiment, and the global events that sent shockwaves through the market. By the end of this episode, you will have a granular understanding of what moved the markets, why they moved with such velocity, and what the most probable scenarios are for the coming days. We will even explore a hypothetical scenario. What if you had invested $100 in a spot position at the week's most volatile point? What would your portfolio look like now? Here's the week in review. The past 7 days have been a microcosm of the crypto market's inherent volatility and resilience. We witnessed a dramatic plunge, triggered by a significant security breach in the DeFi space, which was then followed by a robust recovery that has left many traders and investors wondering what comes next. This week was a battle between fear and greed, between technical breakdowns and fundamental hopes. Let's break it down. Saturday, November 29th. The calm before the storm. We began the week on a note of deceptive tranquility. Bitcoin was gracefully consolidating around the $90,841 mark, while Ethereum held its ground near $2,991. The trading volumes were moderate, with Bitcoin seeing about 62.8 billion and Ethereum at 20.1 billion. The total market capitalization for Bitcoin stood at a formidable 1.814 trillion and Ethereum at 366 billion. On the surface, it was a typical weekend in the crypto market, with many traders anticipating a potential end-of-year rally. However, beneath this veneer of calm, the institutional undercurrents were already shifting. The smart money was becoming cautious. Sunday, November 30th, a whisper of weakness. Sunday brought a subtle but significant shift in the market dynamics. We saw a slight pullback, with Bitcoin dipping to $90,406, a modest 0.5% decline. Ethereum remained resilient, hovering around the $2,992 mark. The trading volumes were noticeably lower, a typical weekend phenomenon, but also a sign of diminishing institutional interest. This was not a day of dramatic price action, but it was a day of quiet consolidation that hinted at the turbulence to come. The head and shoulders pattern that was beginning to form on Bitcoin's 4-hour chart was a classic sign of a potential trend reversal. Monday, December 1st, the day the market trembled. Monday, December 1st will be etched in the memory of the crypto market for some time to come. This was the day the Yuan Finance Protocol, a cornerstone of the DeFi ecosystem, was rocked by a major security exploit. At approximately 2 a.m. UTC, an attacker leveraged a sophisticated vulnerability in the YETH liquidity pool, minting a vast quantity of tokens and draining the pool of its liquidity. The result was a theft of around 1,000 ETH, valued at $3 million, and a total protocol loss of $9 million. The stolen funds were quickly funneled through Tornado Cash. The market's reaction was swift and brutal. Bitcoin, the market's bellwether, plunged 4.8% to $86,281, its most significant single-day drop since March. Ethereum, the asset at the heart of the DeFi ecosystem, bore the brunt of the impact, crashing 6.5% to $2,799. The shockwaves rippled across the altcoin market, with Solana, Dogecoin, and XRP all experiencing declines of over 4%. This was a liquidation cascade. Over $400 million in leverage positions were wiped out, with long positions accounting for a staggering 90% of the liquidations. The largest single liquidation order, a $14.48 million ETH USDC position on Binance, was a stark reminder of the immense leverage that had built up in the system. The Yuan exploit exposed the lingering vulnerabilities in a sector that had attracted billions in institutional capital. Coming on the heels of the multi-million-dollar hack of the Korean exchange Upbit, it created a pervasive sense of insecurity. Tuesday, December 2nd, a glimmer of hope. In the aftermath of Monday's carnage, Tuesday brought a surprising and powerful recovery. The market was not ready to capitulate. Bitcoin surged 5.8% from its lows, reclaiming the $91,345 level, while Ethereum staged an even more impressive comeback, rallying 7% to $2,995. The trading volumes were massive, with Bitcoin seeing 92.9 billion in activity, a clear sign of strong buying interest at the lower price levels. This was a classic case of the market finding its footing, of dip buyers and short sellers taking profits. This was a technical, not fundamental recovery. The underlying concerns about security and institutional confidence had not been resolved. This was a bounce from deeply oversold conditions. The hammer candlestick pattern that formed on Bitcoin's daily chart was a bullish reversal signal, but it was a signal that needed confirmation. Wednesday, December 3rd, the recovery gains momentum. Wednesday was the day the recovery truly took hold. Bitcoin rallied a further 2.5% to $93,619, and Ethereum, continuing its outperformance, surged an impressive 6.7% to $3,195. This was the day the market broke through key resistance levels, with Bitcoin decisively clearing 93,000 and Ethereum surpassing 3,100. The selling pressure had finally abated. The recovery was driven by several factors. The market was correcting from its oversold state, and the positive sentiment surrounding the Federal Reserve's anticipated December rate cut was providing a powerful tailwind. With an 87 to 90% probability of a 0.25% cut, investors were beginning to price in a more accommodative monetary policy, which is typically bullish for risk assets like cryptocurrencies. We also saw significant profit-taking on short positions and a return of some institutional buyers. Ethereum's outperformance was a key theme of the week. Its 14.1% bounce from the lows, compared to Bitcoin's 8.5%, was a clear signal that the market was differentiating between assets. The smart money was viewing the yuan exploit as an isolated incident rather than a systemic failure of the entire Ethereum ecosystem. Thursday, December 4th, a moment of consolidation. After the exhilarating recovery of the previous 2 days, Thursday brought a period of consolidation. Bitcoin dipped a slight 1.6% to $92,141, and Ethereum fell 1.9% to $3,133. This was not a sign of weakness, but rather a healthy and necessary pause. The market was digesting its gains, and traders were adjusting their positions ahead of the crucial Federal Reserve meeting on December 10th. The high trading volume, with Bitcoin seeing 81.4 billion in activity, confirmed that this was not a breakdown, but a period of active consolidation. Friday, December 5th, the market holds its breath, and that brings us to today, Friday, December 5th. The market has started the day in a state of quiet consolidation, with Bitcoin and Ethereum trading within their established ranges. The trading volumes are moderate, and the market is in a state of anticipation, awaiting the delayed PCE inflation report. This report, the Federal Reserve's preferred measure of inflation, will be a crucial piece of the puzzle, a key data point that will either confirm or challenge the market's rate cut expectations. Now, for our hypothetical, what if you had invested $100 in a spot Bitcoin position at the height of the panic on Monday, December 1st, when the price hit its low of $86,281? As of today, with Bitcoin trading around $92,000, your $100 investment would have grown to approximately $106.60, a respectable 6.6% return in just a few days. This is a powerful illustration of the opportunities that volatility can create, but it is also a stark reminder of the risks. On to the technicals. The charts, when read correctly, can provide a roadmap for the market's potential future movements. For Bitcoin, the key support level to watch is $87,000, the low of December 1st. A break below this level would be a significant bearish signal, potentially opening the door to a retest of the $84,000 support. On the upside, the resistance levels are at $93,500, the high of December 3rd, and then the more significant resistance zone between $98,000 and $100,000, a key Fibonacci level. A decisive break above this zone would be a major bullish confirmation. For Ethereum, the support levels are at $3,000 and the more critical $2,950 level. A break below this would be a major blow to the recovery narrative. On the upside, the resistance levels are at $3,200, the high of December 3rd, and then the major resistance at $3,400. The technical indicators such as the RSI and MACD are currently in neutral territory, suggesting that the market is in a state of equilibrium waiting for a catalyst. Fundamentally, the most significant factor at play is the Federal Reserve's monetary policy. The high probability of a rate cut on December 10th is providing a strong tailwind for the market. However, this is not a foregone conclusion. The delayed inflation data will be a key determinant. If inflation comes in hotter than expected, it could force the Fed to reconsider its dovish stance, which would be a major headwind for the crypto market. The institutional flows are another key fundamental factor. The significant outflows from Bitcoin and Ethereum ETFs in November are a cause for concern. It suggests that institutional confidence has been shaken, and it will take time to rebuild that trust. The security concerns highlighted by the yen and Upbit hacks are another major headwind. What are the most probable scenarios? The bullish scenario has a 40% probability. In this scenario, the Fed delivers the expected rate cut and the inflation data is in line with expectations. This triggers a risk-on rally with Bitcoin breaking above the $98,000 resistance and targeting the $100,000 psychological level. Ethereum would likely follow suit, breaking above 3,400 and targeting 3,500. The neutral scenario has a 35% probability. In this scenario, the Fed cuts rates but signals a pause in further easing. The market consolidates within its current range, with Bitcoin trading between 90,000 and 95,000 and Ethereum between 3,000 and 3,200. This would be a period of low volatility and sideways trading. The bearish scenario has a 25% probability. In this scenario, the Fed disappoints, either by not cutting rates or by adopting a more hawkish tone. The inflation data comes in hotter than expected. This triggers a risk-off sell-off, with Bitcoin breaking below 87,000 and targeting 80,000 to 84,000. Ethereum would likely fall to 2,700 to 2,800. For those looking to establish long positions, the optimal entry zone for Bitcoin is between $91,500 and $92,000. Your first profit target should be $93,500 and your second target should be $95,000. Your stop loss should be placed at $87,000. For Ethereum, the long entry zone is between $3,100 and $3,150. Your first profit target is $3,200 and your second target is $3,300. Your stop loss should be at $2,950. For those who prefer to trade counter-trend, short positions can be established at $93,500 to $94,000 for Bitcoin and $3,200 to $3,250 for Ethereum. Your first profit target for Bitcoin shorts is $91,000 and your second target is $87,000. For Ethereum, your targets are $3,050 and $2,950 respectively. The first and most important trigger is a break above $93,500 for Bitcoin with strong volume. If we see a decisive break above this level, accompanied by a surge in trading volume, it will be a strong bullish signal. Conversely, a break below 87,000 for Bitcoin would be a major bearish trigger. For Ethereum, the key bullish trigger is a break above 3,200 with strong volume. The bearish trigger is a break below 2,950. Another critical trigger to watch is the PCE inflation report. If the headline PCE comes in at or below 2.9% and the core PCE at or below 2.8%, it will be a bullish trigger for the entire crypto market. However, if the inflation data comes in hotter than expected, it will be a bearish trigger. The Federal Reserve's decision on December 10th is the ultimate trigger. Before we conclude, I want to emphasize the critical importance of risk management. No matter how good your analysis is, you must always manage your risk. The first rule is to never risk more than you can afford to lose. The second rule is to use stop losses. The third rule is to manage your position size. The fourth rule is to avoid over-leveraging. To provide you with a well-rounded perspective, I have gathered insights from some of the most respected voices in the cryptocurrency and financial markets. One prominent crypto strategist recently stated that the yen exploit was a wake-up call for the DeFi ecosystem, but it doesn't invalidate the long-term crypto thesis. We are still in the early stages of a major technological revolution, and these growing pains are to be expected. The key is to learn from these incidents and to build more robust and secure systems. A leading technical analyst offered this insight. Bitcoin's recovery from 86,000 to 93,000 in just 3 days shows the strength of the 85,000 to 90,000 support level. This is a healthy correction, not a crash. The market is simply consolidating after a strong rally, and further upside is expected once the Fed delivers the anticipated rate cut. A macro strategist focused on the Federal Reserve's role noted that the Fed rate cut on December 10th is the key catalyst. If it happens as expected, we could see a strong rally into year-end. However, if the Fed disappoints, we could see a significant sell-off. The market is highly sensitive to the Fed's signals right now. An institutional trader provided this perspective on Ethereum's performance. Ethereum's outperformance suggests that smart money is accumulating. The 14% bounce from lows is impressive, and it indicates that the market is viewing the yen exploit as an isolated incident rather than a systemic problem. This trader remains bullish on Ethereum in the medium term. These expert opinions provide a valuable counterpoint to the raw data and technical analysis. They remind us that the market is not just a collection of numbers and charts. It is a complex ecosystem driven by human psychology, institutional flows, and macroeconomic forces. To truly understand the crypto market, we need to go beyond the surface-level price action and delve into the market microstructure. This is the study of how orders are executed, how liquidity is provided, and how market participants interact with each other. One of the most important aspects of market microstructure in the crypto space is the role of liquidations. Liquidations occur when a leverage position is forcibly closed because the trader's margin has been exhausted. As we bring this episode to a close, let's recap the key takeaways. The past week in the crypto market has been a roller coaster ride, marked by a dramatic sell-off triggered by the yen finance exploit, followed by a robust recovery driven by technical oversold conditions and positive sentiment around the Federal Reserve's anticipated rate cut. Bitcoin and Ethereum have both shown resilience, but the underlying fundamental concerns about security and institutional confidence remain. The next 24 to 48 hours will be critical. The key technical levels to watch are 87,000 for Bitcoin and 2,950 for Ethereum on the downside, and 93,500/98,000 for Bitcoin and 3,200/3,400 for Ethereum on the upside. Remember, the crypto market is not just about making money. It is about understanding the forces that are reshaping the global financial system. Stay curious, stay informed, and stay empowered. Thank you for joining me on this journey. This is Boni for Boni's Life, reminding you to trade wisely, manage your risk, and always stay ahead of the curve. Until next time, stay safe, and I'll see you in the next episode.